Welcome back to the Build Boldly podcast. I'm your host, Pat Rodgers, and today I am joined by a friend of mine, an incredible entrepreneur, Logan Burchett. He's the founder and COO of Forecastr, a software company that supports SMB and mid-market companies with financial forecasting, analysis, and planning, which is so necessary for the growth of scaling businesses and understanding where you're at. So Logan, welcome to the show. Very happy to have you today.
Pat, thank you so much for having me. Looking forward to it, and happy to be on here.
Awesome. Well, as I mentioned, I've known you for a while. We've partnered in a former life, and we brought Forecast for some of our clients. So I'm a huge fan, and I think I'd be remiss if I didn't ask you to give us the origin story of Forecastr, because I think it's such a great story of kind of how you guys got started, why you got started, and it'll set some foundational pieces for us.
Yeah, no, I really appreciate that. So, kind of my origin story has always been in finance. I've been a finance guy through and through, and I actually started my career in big finance institutional asset management. So I worked at the Kentucky Pension Fund. And so my story of how I got into the space that I'm in today, which is venture finance, kind of finance for companies doing, call it 1 to 50 million, it actually started in investing where I was picking stocks. I was doing all this stuff for the pension fund. And there's a guy that I sat right next to, and his name was Anthony Chu, and he managed the venture capital portfolio. So it was like a $2 billion VC portfolio. And I found myself way more interested in his work than my work. So I was like, man, this guy gets to learn about all these cool cutting edge technology companies. I'm way more interested in that than what I'm doing over here looking at stocks. So that sort of led me to getting introduced to a firm called Venture First, based out of Louisville, Kentucky. And they were standing up a fractional CFO services division of their company. And so that was the first time in my life where I was able to actually work with companies that were building something in the early stages. They were seeing this really cool rapid growth. But most importantly, the numbers and finances were very important in helping them make decisions, right? Which is kind of new to me. Being on the investing side, it's like finance is just inflows and outflows. It's just numbers and metrics that inform you on whether to invest or not. But now you're in this world where they actually inform strategy, and that can lead to people getting hired, and that can lead to growth, and that can lead to all kinds of really cool things. So I started there, and I worked as a fractional CFO, and I built out this book of clients underneath me, and was working with companies doing, that were kind of between seed and Series B, and um, and that's where I met my now co-founder, Steven. But it's also where I just learned about all these really like acute pains of early stage finance, where it's all, at least back then, it was still centered around Excel. Companies had some data, some of them did, some of them they didn't, and it was of varying qualities. But it was this incredibly manual process where you'd have to go in, you'd have to upload data, you'd have to build a forecast manually. And whenever anything's manual, more hours equals more costs, right? So for you to get any value out of finance, our clients would have to pay us sometimes tens of thousands of dollars a month. I mean, it's very expensive because it's just that much work. And so, me and my co-founder now, Steven, we kind of took in the whole scope of just this world of early stage, venture. And we noticed that every business function had a supporting software to supercharge it, right? I mean, you have cap tables, equity management that was supercharged by Carta. You have accounting that was supercharged by tools like QuickBooks and Xero and things like that. You've got hiring and firing and people management is Gusto, supercharges that. You get down to FP&A, which is a cornerstone business function, and it was still just Excel, right? There was nothing to really power it beyond that. And so we were just crazy enough to look at that and think, well, hey, we can do that, right? What if we built this thing that was really the software that supercharges that, kind of pushes it forward? And that was the origin story of Forecastr. And that was way back. We had the idea for it in 2018. And then since then, I mean, a lot's happened since then. But just to give you the high level kind of like metrics, I would say we've scaled it up quite a bit. We've raised about 20 million. We built it to a 50 plus person company. We generate millions of dollars in revenue, and we're just growing. We're having a lot of fun, and we're building really cool things to just help power these companies that are in this, what I would call like the messy middle of finance, of like, call it 1 to 50 million in revenue, and that's really where we can kind of attack and provide the most value.
That's awesome. And you guys haven't lost some of those roots. You still have kind of that outsourced CFO service, the analyst service. And I think that's so unique because it's either today, I feel like you either have to pay an arm and a leg for a true fractional CFO without the software that you can actually go in and understand, or you now have this option where we have kind of the human in the loop aspect of I have control, I have visibility, but I have somebody I can also lean on if I need to. And that blended model is so great for entrepreneurs that, for the most part, this FP&A, financial planning analysis, is not their cup of tea. It's not why they started a business. It wasn't their original skill set. It's scary as hell. It's just this mess that you're like, hopefully there's enough cash in the bank. And that's my analysis, right?
Yeah, you nailed it. And thanks for calling that out, because that is what we believe, and kind of what we're proving actively is the winning model, especially when it comes to finance, right? And we're in this kind of weird world. I think we all are, right? It doesn't matter what kind of business you're in, but we're in this world where AI is really coming front and center, and everybody's trying to figure out what that means for them. And so what we've noticed is that in the office of the CFO, whenever you're dealing with finances, there's a lot of things that are true, right? One thing that's true is that, really people are looking to get impact. They're looking to have things taken off their plate. They're not looking for a cool new software that just gives them another job to do, right? They're really just looking for this. If I'm a CEO or an operator of a company that's kind of in our space, they're really just looking for the job to be done rather than a software to help them do the job. So that's kind of one piece of it. Another piece is they don't usually have a CFO in that seat, right? Because whenever we're at that kind of like earlier stages, a CFO is a very expensive person. So if you're not looking for a software that just does the job for you, or that's not the best avenue, and you don't really have somebody that's managing this full time for you, then that hybrid model hits so hard, because we can just come in and say, hey, look, we are this kind of one-stop shop where we can provide this incredible software that we've spent all this time and effort building, and we can pair that with somebody that is an expert at this stage of finance that's going to deliver a ton of impact using that software. Now you don't have to worry about hiring anybody, and you don't have to worry about going out and finding a software. You're just capitalizing on impact. And it's an important thing to note too, which is that there are things in the world that AI is just taking completely away from founders, right? There are businesses that AI is just killing. And in some ways, AI is impacting finance dramatically. But in this particular aspect, of businesses doing probably 1 to 50 million in revenue, um, the the stakes are so high that you can't just outsource it to a robot and trust it fully, because AI hallucinates all the time. In this case, if AI hallucinates, that's people's jobs. That is your literal business at stake. So it's too high stakes to give to a robot.
Yep.
And so it's kind of cutting off kind of the bottom of finance, where it's like really just people looking to build a model to fundraise, and the very top of finance, where people are doing a lot of data entry and things like that. But we're a big fan of the human model, the human plus AI plus software. It's working great for us.
Totally agree. There was I was talking with somebody the other day, like LLMs, which are the backbone of all AI today, large language model. And so they're all still catching up on the actual numbers, financials, understanding, and you still miss so much context of what's happening in the business, what are the goals of the business, all of these things that asking simple questions doesn't always get you the right answer. It's a hallucination or not. Even if it's not a hallucination, you might be guided in the wrong direction because there's missing context. And so I think that's such a great point, and that's why I really love the model that you guys are creating, because it gives you the best of both worlds.
It really does, and it's also interesting too. I mean, anybody, there's always like a meme when it comes to ChatGPT, right? Where like if I go into ChatGPT and I say, "Hey, ChatGPT, can I play in the NBA in 2 years if I really work?" It's probably going to be like, yeah, you can do this. Like, I'll give you this
I'll
training
get
program.
it.
Like, go do it. And you can really believe it. It's going to take discipline, but it will like literally try to convince me that I can play in the NBA. All right.
Right.
So I'll now extrapolate that same kind of logic to business and business finance, where if I'm an operator, right, and I've got kind of dollar signs in my eyes, and I've got all this ambition, and I go into, the wrong AI, and I'm like, can I do $100 million next year? That AI might just trick you into thinking that you can do that. And it might just tell you to go hire a bunch of people with that plan in mind. And it'll give you all kinds of bad advice, right?
Oh
Because
yeah.
it's not a human.
Yep.
And AI messes up so much. And I think there's this interesting kind of wave that I'm seeing with AI where when it was first introduced, everybody thought, well, this is the best thing ever. I can replace everything in my business with AI. I'll just plug it in here and then it's done and we're good. It's going to save me so much time. And then you then you had everybody kind of get this like, oh shit moment when they realized like, oh wait, this actually isn't quite as good as I thought. And actually it's making all these mistakes and actually there's all these problems with it. And so yeah, I mean it's definitely it's critically important to have somebody there. Don't shy away from AI. We certainly don't.
Right.
We've been flowing through our entire product, but if you do it without a human, you're cruising for a bruising, especially when it comes to finance.
Absolutely. Absolutely. Well, and to give some additional context, I think is, you mentioned QBO and Zero, and we had a conversation a few weeks ago with an accounting firm that was focused on that aspect. And you guys plug directly into these systems. So we still need that kind of baseline. Good data in is equally good data out. So we need that accounting background. But now what we're answering today is really, what do we do with that data? How can we leverage that to understand our growth, to understand the next step, runway, you name it? And so I think that's a foundational principle that you can't skip steps, but you can enhance this aspect of the business as you move forward.
It's absolutely true, and that's honestly why I'm just personally so drawn to the office of the CFO, to financial planning and analysis, because it's where, in my view, it all comes together, right? I'm a data guy, I'm a math guy, I'm a finance guy, and so you're absolutely right. Like, it is critical to have somebody that is overseeing the historical data, that's overseeing all of the accounting data, because to your point, it's like a trash in, trash out. If you're using that data to extrapolate and look into the future and it's bad data, it's going to hallucinate just like the AI does, right? Because you're not actually operating off of good information. And so, the way that I explain kind of FP&A and its role in business is like I like to use this car analogy where if I'm driving a car, right? I've got the rear view mirror, and that's accounting because that shows me what I just passed, right? It's kind of analyzing the past of what has just happened. But the really important thing is the windshield, right? That's where how you can kind of see what's coming up, and that way you can react and you can adjust and you know what to do once you have the information of what is coming down the line. And so that's really what FP&A is all about. It's showing you what is actually coming down the road, what are the things that you have to pay attention to, and it's situationally dependent, right? And that's kind of the cool thing about FP&A, where I'll give you like two big use cases to kind of like show how each of them can apply. So on the one hand, you may have a SaaS founder, or maybe it's an agency owner or somebody like that, that they don't want to raise venture capital. They really don't want to raise any money at all. They're more of a highly profitable lifestyle business, right? So if I'm the founder of that company, what's important to me? Well, maybe what's the most important thing is generating as much cash as I can possibly generate, maximizing the profitability of that business so that I can take as much of it home as I can and spend time doing whatever it is that I like. Okay. So in that world, the purpose of FP&A is to look into the future and say, okay, how can we maximize efficiency? How can we set our metrics, and how can we set goals in our hiring plans in such a way that we can maximize the amount of cash that the founder brings home, right? That's one use case of FP&A. On the whole other side, there may be a founder of a company that is maybe more like Forecastr. It's a hyper growth startup that's raised tens of millions of dollars that wants to go on to raise more money, that's looking to be a unicorn. And they're growing at a breakneck pace. They're hiring dozens of people a quarter, if not a month. And so to them, it's continue on this growth path, communicate goals and performance to investors, and make sure that we don't break the thing while we throttle it,
Yeah.
right? And they're both critically important, and they're both strategic, right? You're kind of marrying what the company goals are in such a way that it makes sense and it's a cohesive strategy, but they're wildly different in their application, right? And so and that's kind of like the art and the science of finance is like, a as somebody advising that company, you have to understand what's important to them so that you can kind of contextualize the goals and give a plan, build a plan that is in accordance with those goals, right? What gets measured gets managed. It's kind of the framework there. It's like, let's put the plan together, let's stick to the plan. And so it's very important to have somebody that has that context in mind. And then once you have that and that plan built, it really comes down to just execution and making sure that you are able to actually do what's in the plan, you know?
For sure. But I think, the those two scenarios you outlined, for our audience of, builders out there, the two scenarios, I think any entrepreneur is like, yeah, let's maximize cash, right? And so for so many of these groups that, we work with in our audience, it's businesses, it's, scaling that, it's building a nest egg for your family. There's also the side of that growth, which might be getting a loan from a bank to go acquire a new territory. It might be future PE exit that is the true cash, and maybe you're rolling some of that forward to actually be able to get the second bite at the apple. So I think there's so many of those scenarios for our audience that, think of VC very similar to PE in a very condensed way, because VC is a very unique beast of its own. But at the same time, if we're going to get PE involved or you're going to get a bank loan, understanding this financial output is so critical because it can swing the valuation of your business. It can swing the credit worthiness of your business, all of these elements that actually allow you to grow. This is the type of stuff that answers those questions.
Absolutely, man. And that's like one of the key jobs of really anybody running an FP&A function, especially the CFO, is, I mean, a lot of this comes down to setting goals, managing cash, all of those things, but it's really storytelling whenever it comes to things like future financing, whether that be debt financing or an exit or raising money or an exit, right? And so here's kind of the way that I try to explain it to people is, you know, somebody that's running a good FP&A function, somebody that is forecasting, that is paying attention to the numbers. What you're doing is you're setting goals, and then you're managing the variance to those goals once the month ends, right? So we have revenue targets, expense targets, budgets, all those things that we want to hit. Once the month closes, we look at how we performed, we document that, and then we let those inform new goals. And you run that process out. You can run that process out for the life cycle of the business, and then that's how you get tighter and tighter. Those variances get smaller and smaller, and how you get a clearer and clearer view of the future, right? So now let's apply that logic to a scenario where you're getting a bank loan or you're about to sell your company or something like that. Well, anybody that's has any sort of a vested interest in your company, be it a lender or an acquirer, they don't really care that much about the past of the company. That's good data that they're going to use whenever they're making their decision. But what's much more interesting is the future of the company, right? So what's going to happen from here on? And so really the job of anybody running this function is to paint that future in the most compelling way that you can on behalf of the company to try to maximize the valuation and try to alleviate risk from the person investing in believing that future, right? So like if I as the CFO can help paint a compelling and interesting and valuable future of the company. If I can do that and I use FP&A to do that, then how do I get somebody to believe that? I can show them the receipts of how I performed up into that point. So I am much more inclined to believe an aggressive forecast from a company that I'm about to invest in if I can see that they've historically hit their forecast and they've been very good about keeping tight variances on that forecast. And here's why that's important is because one way or another, the person that is going to give you that loan or acquire your company is going to do some form of their own forecasting or some form of forecasting in general. They're either going to lean on the forecast that you provide or they're going to make their own forecasts, right? Or some variant of that. And so they're going to be much more inclined to believe your numbers if you have a good FP&A function and you've spent the time refining and showing those type variances. If you don't have that, they're going to tear down everything that you put in front of them and they're going to rebuild it themselves. And by the way, you want them to believe your numbers because you are taking the time to make them as compelling as possible. And that to me is the big unlock, that it's kind of the hidden benefit, but it's a massive one of the office of the CFO because I had a mentor very early in my career, as a very seasoned CFO. He was the CFO of multiple $100 million exit companies of exit for multiple hundred millions of dollars. And he told me that a good CFO can add, multiples on revenue at exit simply by doing a great job of telling the financial story and de-risking it whenever an acquirer is looking for it. So yeah, it's a massive benefit that can be unlocked through just the power of good storytelling.
Growing a business shouldn't cost you your sanity. One founder told us,
had I not made that decision to go into this space, my business, my personal life, and my sanity, and my family's sanity would have dwindled very quickly.
Rise exists to support real entrepreneurs through real growth by giving you secure, flexible space and the support to scale without burning out. Office, warehouse, and business space, all designed to help you work smarter, not harder. Learn more or book a free space planning call at risecommercialdistrict.com.
And when we talk about de-risking, what we're talking about is somebody's going to come in and say, I'm going to buy you for X. And I want to reduce the risk because I'm expecting 2 times whatever I bought you for in the end, right? And so by showing that understanding of the business and the proof points, that allows them to feel comfortable, essentially de-risking their investment into you. And I think that's so critical. And to your point on kind of how that's presented in the story, the more professional, the more buttoned up, the more accurate based on historicals that information is, the less likely they are to say, I'm not looking at anything you gave me and I'm going to go build something new, because when it feels real and is real, that trust is built as well. And I think at the cornerstone of any transaction is trust. And so if you can bring that to the forefront, you're going to have a lot more cards in your table by giving them the right information.
Absolutely. And you just nailed it. And it's also just general human nature and negotiation. So like, I'll tell you this story of one of our clients. It was a pretty interesting one where, it was one of our founders that was looking to, he had an acquisition opportunity in front of him, and he was able to almost like, he didn't even mean to do this, but he got himself a significantly better valuation at exit, because whenever they were looking at their numbers, they wanted to give him a multiple of his current ARR, his annual reoccurring revenue. And they were like, okay, well, here's how much revenue you're doing. And, we'll apply a multiple to that. And here's what we think the company is worth. And he looked at it and he was like, well, yeah, but by the end of this year, and there's like 6 months to go for the end of the year, he's like, I'm going to be at like double that amount of revenue. And I feel very confident in that, because look at how tight we've been. We always hit our forecast. Like we beat our forecast. Like, and our forecast is not super aggressive. They were growing very quickly. And so he was like, it makes no sense for me to take this deal right now when I have a 97%. I'm 97% confident that at the end of the year, we'll be worth basically double the number that you're putting in front of me. So like, no, I'm not going to do that deal. And so anyway, what the end of the story was, they gave him a multiple on forward looking revenue, because because it was just human nature. He wasn't even trying to negotiate. He was like, this just doesn't make any sense to me. And I've got this right in front of me that I'm very certain we're going to come at least directionally close to. So there's just a lot of stuff like that is just, there's a reason that every $1 billion company you've ever heard of does this, that does right. Forecasting. That's how the rich get richer, is how,
Absolutely. And I love that point too, because it also, as the founder, gives you that insight of, well, in 2 years, I could be at X profit, margins higher, revenues coming in. Why would I take this deal today? It might look sexy today, but if I can actually see that future, I'm like, I can make that on my own. Why would I take this deal, right? And so it also gives you some protection there. And I think that's really what I think we'll get into the nuts and bolts today, is protecting yourself, getting that visibility, and really understanding, where we're going. And so I'd love to hit on some just blocking and tackling.
Yep.
What are some of those core principles of FP&A that a platform like Forecastr can unlock for you? Thinking about cash flow, revenue forecasting, budgeting, things of that nature, that are those foundational principles that don't necessarily happen in accounting and QBO and those places, but a founder and owner and operator should be doing, and really understand that language to be at the top of their game and really grow their business?
It's a great question. There's several things that come to mind. So one is just analysis, right? When I think of financial planning and analysis is a key piece of that. And a software like Forecastr, a company like Forecastr, which is really an FP&A function software. I mean, really what we sell is the impact of FP&A. It's really where in the moment everything comes together. So you have your accounting data, which is giving you great financial insights, but then you've got other data too. You have data maybe coming from your CRM. If you use Stripe, you have Stripe data. If you have subscriptions, you have churn data. If you have a payroll software that you use like Gusto, you have payroll data, right? So you can see what everybody's paid. So one of the powers of a software like Forecastr and the service that we provide is being able to put it all in one place and then analyze it all together. So where you might be able to, just using your accounting data, look at how much runway do I have left, or what is my gross margin, or what is my revenue growth rate. We can cross-reference that with all of your other metrics. So we can, once we have customer count, we can look at things like cost to acquire a customer. We can look at payback period. You can look at unit economics. And this is where the analysis section of FP&A really gets supercharged, and a tool like Forecastr just helps with that tremendously, right? So that's kind of one thing. Another piece of it, which you touched on, is budgeting, right? Which budgeting and forecasting is kind of interesting. They're the same things. They're two different words for the same things, but budgeting is a more intentional, type of forecasting where it's just being very diligent about saying what you want to spend your money on and then sticking to what you're trying to, I think everybody is intimately familiar with a budget. But the cool thing about a tool like Forecastr is with our software, we have permission controls and things like that, where we can set a budget, assign an owner to that budget, and then really make sure that that owner that has the, ability to spend within that category can actually stick to that budget, right? So it's like building the best budget in the world is one thing. A budget's only as good as your ability to stick to it. And so that's really what we try to do in our software, is help founders stick to budgets. So it's analysis, it's sticking to budgets, it's setting smart goals. And I say smart in that it's easy to say something like, I want to grow revenue by 20% this year, right? Okay, that's easy. But what's more impactful is saying that same thing and then having all of the metrics that back that up to understand, well, if that's true, how many customers can I afford to lose? How many customers do I need to sell at any given month? At what price point? What staff do I need to support that, right? All of that. So it's like understanding and cutting up the steak is what we call it, is understanding what needs to be true in order for you to ultimately hit those goals. So you've got goal setting, and then the one that I just touched on, which is headcount planning. Headcount's 80% of the cost of most companies out there. And so knowing who you're going to hire at what time has a massive implication on your cash flow. So that's a massive piece of that as well. And I'll end with this stat, which I think is really important. And honestly, if I had to use one stat to convince anybody to do forecasting or look at FP&A, it'd be this one. I think we all know that 90% of companies that get started, I think it's north of that now, end up failing within the first, whatever it is, like 5 years. But the stat that people I think are less familiar with is that 83% of the companies that end up failing due specifically to poor cash flow management. And this is something that I've built my career around. I see founders all the time that say, I logged into my bank account, I don't know what happened, but my account balance is half of what it was, and I really don't know what's going on. Could you help me? It's that type of a thing. And that's a good thing and a bad thing for really every founder. It's bad that it happens because nobody likes companies to die. I think we all love entrepreneurs and entrepreneurship. But the good thing is that is a completely solvable problem.
Right.
Where if all you do is have a cadence every month where you pay attention and you look at cash and you analyze what's going on and you put a plan together and you audit how well you're performing to that plan, that will all but guarantee that you will not die due to poor cash flow management, which is by far the number one most likely thing that is going to kill your company. So, one of the things I tell founders is, if you work with a company like Forecastr, I can reduce your chances of failure by roughly 83%. It's a bit of inflated statistic or whatever.
Sure.
Good way to get the conversation started.
Yeah, absolutely. Well, I think that's, the for those that aren't totally familiar with cash flow, it's essentially I'm going in and I'm looking at that balance sheet, my bank account. But really what it is what am I bringing in and what's going out, and why did that happen and why did that change? Because ideally we're fairly predictable. We're going to bring in this is much going to go out. The more we can control what's going out and increase what's coming in, the better our business is going to be. But to your point, that then impacts, when do I hire? When do I buy that next truck? When do I buy the next gear? When do I get more inventory? And all of those questions really are set around cash flow management as kind of a core principle of FP&A. And I think that's where, to your point, when you miss all of those ins and outs or aren't paying attention to those ins and outs, that's where things can go sideways.
Absolutely. And it's easy to get confused by what your accountants send you. If you haven't built, I mean, if you're not somebody like me that's been doing this for over a decade, we have founders that come to us all the time that say, I have an accountant, I trust them, and I know they're doing good work, but I have really no way of applying what they send me and doing anything with that. And it's interesting because there's multiple things that go into it. It's like, one, for a multitude of different reasons, the profit that's on your income statement is not the cash that you're collecting every
Not
month.
accurate. Yeah.
Not ac- and it can vary wildly, and
Yeah.
people discount that, right? A lot of people think, well, that's about what I made. Um, but in reality, for so many reasons, that could be totally different. And this is what confuses a lot of founders is they look at what's on their P&L, they look at what's on their income statement, and they think, hey, I'm profitable, I'm good. When in fact, you can be profitable and still be losing money every single month. That's
Yeah.
probably one of the most common things that I hear is from founders that are bootstrapped that come to us is, I don't get it. I'm profitable. I get my income statement. I'm profitable. My bank account keeps going down. What gives? It's like, okay, well, let's open that up and answer that question, and you dig
Yeah.
in and kind of understand all of that. So, yeah, that's a big piece. Is just understanding profitability does not equal positive cash flow, and again, putting a plan together that ensures that if you stick to it, your bank account will go up, and that's the goal. For companies that are in that bootstrap maximize cash flow, that's absolutely the goal.
Yeah, absolutely. When you brought up a term earlier that I want to come back to, and it's ARR, or annual recurring revenue. And depending on how your business is operating, that might be MRR, monthly recurring revenue. But I think one of the pieces that is finally starting to come into the service industry and a lot of these groups that we work with is this idea of a annual or monthly service contract, right? So maybe I'm a plumber and historically I'm like job to job and I'm going in and completed. Okay, now I got to go find the next job. And now we're starting to see the shift of, hey, for X amount a month, you can now come out, we'll do a visit for free. There'll be additional costs if we find something, but if you just need a check, you're not going to get that, quick hit. But what happens is that starts to compound and allows you to capture more revenue with less work. And so that's a really interesting concept that I want our audience and builders to really think about is, how can you build in that kind of monthly recurring revenue or annual recurring revenue, because it allows you to be so much more predictable, which then allows for things like modeling to really take shape and give you that runway and path to either path to profitability or path to greater margins and profit. And so I think that's a really interesting concept. So when you're thinking about that from Forecastr, what are the things that people need to understand about that revenue growth and how that can kind of impact the ins and outs of the business?
A very, very good thing to call out. I'll come to that here in just a second, but
Yeah.
I'll also just note that all the things that everybody loves about reoccurring revenue, acquirers, investors, lenders, they love just as much. And so one of the key things that is important to understand as an operator is that not all revenue is created equal, and some revenue is way more valuable than other revenue. And so whenever it comes time to exit, if you have, I'll use a technology company for example. Like if you have reoccurring revenue and you have good technology, people will pay up, sometimes 10 times, 12 times what your revenue is, versus if I'm like a consultant and I'm just charging hourly or something like that, then the acquirers might pay me 1 times what my revenue is. So one's worth 10 times what the other one is. And so just being able to do a bit of revenue architecture and try to map out, like, how do I get not just as much revenue as I can and the most revenue as I can, but the best quality of revenue as I can. And that's really where this thing starts to get strategic, and where you're maximizing your wealth as a business owner, because then whenever it comes to sell, you'll be able to sell for way more money. So that's kind of how one way to kind of think about like different types of revenue and being like intentional about the type of revenue that you build. And then how does that apply to things like Forecastr and trying to extrapolate things into the future? Well, there's a lot, that goes into that. But a couple of things to keep in mind is that, you know, even companies that pay you monthly, they are not going to pay you monthly forever. And so a very common mistake that I see people make is they just stack these monthly contracts on top of each other, and they assume that nobody's ever going to cancel, and they don't factor that in. So they're just like, oh, if I just keep getting these customers that pay me hundreds of dollars a month, and I do that over and over again for 12 months, then my revenue is going to be this massive number. But then once they get into it and they're starting to see cancellations and they didn't factor that in, that's going to kill your projections, kill your plans, all of that. So I think that's a big one to factor in whenever you're looking at future planning. But then the other one is where it gets a bit more technical and specialized. But this is really kind of the area that we live in, that I think is really fun. It's being able to leverage revenue like that to understand when to invest more in growth and when to not invest more in growth. And this is where we have decades of finance that is teaching us, like, this is when to invest and when not to invest. So I'll introduce a couple of important concepts and not try to get too in the weeds with it. But basically, there's one concept of lifetime value of a customer. And this applies to any business, but I think it's really interesting in what you just brought up, Pat, which is subscription businesses or people that pay monthly. Um, so if I get an average customer, let's say I have 100 customers and they're all paying me monthly, on average, how much are they paying me every month? And on average, how long do they stick around?
Yep.
Right. So if on average I get, customers that pay me $100 a month and they stick around on average for 10 months, then I've got that lifetime value is $1,000. One customer is worth $1,000 to me. Right. And so once I understand how much I get out of an average customer, then that informs how much I'm willing to spend to get a new customer. Right. So if I know that I can get one customer is worth $1,000 to me, or I'll say 10,000 just to kind of like, so let's say I have a customer that's worth $10,000 to me. That tells me that I could probably spend $3,000 to go and get a customer. So that means I can invest about $3,000 in paid ads, in going to events, and maybe hiring, salespeople and baking in commission and all of that. And that informs how I can grow my business. And versus if it cost me $10,000 to go and get a new client, automatically I know, okay, wait, nope, something's broken, because as soon as I'm literally losing money, servicing the client, because I spent all my money that it's worth just getting the client in the first place. So that's a bit in the weeds, but that's another thing that's really important is once you get all of this data and you're able to really look at it critically, then this where having somebody that knows what they're doing working with you helps, is we can kind of crunch those numbers a little bit and then say, hey, go hire another person, go invest more in paid ads, spend more money because your economics are great, versus hold off a little bit. We got to fix some things, and let's maybe not invest in growth right now.
You read my mind, because I think the biggest thing to that kind of cash flow issue with founders and new businesses is this overall, how much are we spending to get somebody, client acquisition cost, also known as CAC. If you heard some of these terms, the beautiful thing about it is either I find out that I am spending too much, which is almost always one of the biggest reasons people go under, is I'm not making up. I assume that eventually I'll make that money up, and I never make that money up. The other is you stagnate because you're not investing enough, and you really could be investing and growing significantly faster, but now you're dealing with that kind of cautious concerns, scary. Do I hire that person? Is it really going to work out? Do I really spend X amount on ads or hire an advertising agency? Is it really going to be worth it? And I think this is where that FP&A and general forecasting come in to say, yes, you've reached that point in time, or hey, you need to pull back or things are going to fall off the track real fast, right? And I think that's such a critical component that people don't really, when you're just getting a business started and you're just hoping for growth, you're just trying to get out there and you're not really looking at those numbers. And I think that is such a key piece of this puzzle, because that is where businesses, revenue is the lifeblood of every business. If you're not figuring it out, it's going to end up poorly. And so I love that you kind of highlighted that. And then we did get in the weeds a little bit, because that's ultimately where things, win or lose at the end of the day.
Big time. I mean, that's one of the benefits of numbers is numbers don't have feelings, right? They don't have emotions, and they just are what they are. And so that's what's so great about them in a business context is being a founder, being an entrepreneur. I mean, it's such an emotional roller coaster. I mean, you have to be a little delusional to be a founder in the first place. And just having somebody, some system, something to check you and say, okay, cool, but these grounded in reality numbers are telling me this story, right? I think that is just it's so important. And I'll share this with you, Pat. Like I was reading this article. I shared this with my CTO. We were talking the other day, and it was talking about how founders shouldn't set goals, revenue goals, or forecasts even for their companies on their own, because they are so divorced, they're so delusional, they're so invested that they literally can't think critically and objectively about the metrics and the forecast that they set. And the whole point of the article was work with another person that is not inside of your organization. Work with them to set your forecast, because they don't have the same biases that you do, right? And I just read that and I was like, spot on. That is spot on, because numbers, when they're done right, they're not biased. They don't have emotion. And if you pair that with a person that knows what they're doing, but they're not sharing in the upside with you the same way as maybe a CFO that's internal would be, or that you as the founder are, then it just forces objectivity, and it's it's a beautiful thing.
Yeah, absolutely. Well, and you mentioned we've kind of gotten into a couple topics, but the other part of this is that kind of cost control side of things, right? And you mentioned the budget and having the ability for different departments or individuals to understand their aspect of the budget, because that's the other part where somebody might be spending your money and you're not totally aware of where it's all going. And I think this is one of those critical areas when things are coded correctly, you really understand where the ins and outs are, that you can really control that. And I think that's, everything from, if I am going to hire that employee, is it time? What is the right base that I can actually achieve for this person? If it's, if I'm a wholesale and distributor, is it time to get a new truck? What's that truck going to cost? What's the lease on that, or the loan? All of those different inputs. And when you're thinking about this is where all of it really comes together, of starting with my baseline budget to say, I want to get to X. And now I've got to actually look through and understand all of the inputs to get there. And that is overwhelming, right? I think at the end of the day, and there's always blind spots. And if you've never done this before, you have no idea what all those blind spots are. Unemployment comes up, or insurance goes up, you name it. And so when you guys are working with folks, what's some of the advice in terms of setting that budget, getting an initial forecast, and really understanding how all those inputs come together to give them a real picture, not a glorified, beautiful one-day fantasy land, but a today picture when they're first coming to you, to make sure that they're ready and understanding where they need to go?
Yes. So it's a great question. This is such a critical step in forecasting that so many people miss. And it's getting buy-in from the people that are doing the work. Right. So here's what I mean by that. If I'm the CEO of a company and I'm like, all right, we need to generate $50,000 of new business this month. And I'm also setting the marketing budget, and you have to achieve that with $5,000 or something like that. If I set that and I do that without the person that's in charge of doing that work, that is in charge of getting that revenue in the room, what do I know? I'm just setting audacious goals and setting, I'm going to make expenses as low as I can, and I'm going to make growth as high as I can. And so the critical step is like taking the people that are literally going to be growing the business, doing the work, your head of marketing, your head of sales, your head of partnerships, your all of that, and saying, help me craft this. Let's craft this together. And it's more and it's less of I'm going to set my growth goal and then I'm going to set your budget. It is I'm going to set targets for the business. Help me understand what you need to achieve this outcome, right? And so now they are opining on what they need in order to do that. And when they do that, they're getting buy-in in the process. And you're not setting, pie in the sky projections that are impossible, right? Where forecasting starts to lose its value very quickly is if you just set this crazy forecast that is completely divorced from reality, you plop it in front of your team and they just roll their eyes and they're like, you are insane and this is stupid, right? If you don't, but if you're intentional, that's not going to happen. If you're intentional about bringing the right people in to help you craft it in the first place, that's whenever it becomes a barn raising where everybody gets really excited because they now have say in the resources that they get to achieve the outcome. And especially if they have ownership in the business, that can be very motivating because they're seeing how it all fits inside of a longer term vision, which is really cool with forecasting because I can show you how much money we're going to make this quarter, but then I can zoom that out for the next 5 years and show, hey, if we keep doing this over the next like 5 years, this is what that ultimately looks like. And this is how that connects back to you, right? As a person that's in charge of the business, this is what maybe salary increases could look like. This is what maybe profit sharing could look like. It's a great motivation tool because it forces you to think in financial terms, and people always apply that to their lives. They always look and say, well, okay, right now we're doing 3 million in revenue, but if we really do 15 million in 5 years, what does that mean for me? I might be making way more money and things like that. So it can be really cool.
Yeah, absolutely. And you kind of led me to that idea because we talked about, budget and forecast fairly similar. Um, but the other layer or the next layer comes back to that analysis. And something that I love about your platform and in general, when you really have a strong FP&A function, is scenario planning. Because now we're in the what if moment of choices that we can make and directions we can go. Because as a founder and owner, am I going to expand my distribution routes? Am I going to buy a new territory? Am I going to add a line of service? All of these questions, because you have so many avenues as an entrepreneur and your mind just naturally is like, what's the next thing? And so you have all these options and you want to be able to say, what would it look like if, and not necessarily be a part of the budget or the forecast, but what if? And that's something that you guys do really well. And can you give our audience just an idea of what is scenario planning? How can it be useful in terms of decision making and planning the growth and trajectory of your business?
Absolutely. So first of all, let's talk about what is scenario planning. And let's start by like really, and this is probably something we should have done at the very beginning, but defining what actually a model is, like really functionally. A model is basically a mathematical simulation of your business. You boil your business down into all the metrics and numbers and everything that drives it. And then you postulate or whatever you try to understand, given all of these numbers and how they all work with each other, if we continue on this path, what happens to the business, what happens to revenue, what happens to cash, what happens to all of it, right? How does this play out? How does this story continue to play out over the next several months, quarters, years, what have you, right? So that's kind of what a model is all about. So now you can introduce things like a scenario planning. And so what that is it helps you make different decisions on the business and what to focus on depending on different outcomes, right? So like I'll give you an example. This is a popular example for scenario comparing or scenario planning is should we raise our prices, right? That's something that every business owner struggles with at one point or another. Should we raise our prices? So what a model can do and what scenario planning can do is help you say, well, okay, if we raise our prices by 20%, and let's say that we think that our conversion rate's going to take a hit. We're not going to sell as many customers if we charge more. well, what could it fall by for us to be better off, right? So you can kind of paint that picture and say, let's see what revenue would do if we did raise prices, and let's say that people left and that people, all of that. You can kind of understand whether or not you should raise prices, whether or not you should hire this person, whether or not you should increase paid ads, all of these things. You can simulate out what happens. So it's a great decision making framework, and it kind of shows you what to focus on and what decisions are going to be good and what decisions are going to be bad. That is one very important aspect of scenario planning and scenario comparing and all of that stuff. But I'll give you one more, and this is the one that actually I think might even be the most powerful emotionally. If nothing else, it's a great emotional superpower that I see all the time with the founders we work with, is forcing you to confront your absolute worst case scenario. This is a very important and powerful thing that we do with clients is, okay, we all like to think about what happens if we triple revenue, what happens if we close that round of funding, that new loan, whatever, and we're able to hire everybody and all of that stuff and all become multi-million. That's all great and fun. And you should do that, right? That's a cool exercise to do. But what is the worst possible thing that could happen to your business? What happens if growth slows? What happens if half your clients leave you? What happens if AI takes over your industry? What happens if all of these things? And as founders, we're always walking around stressed out. Whether we know it or not, that's kind of playing in the back of our heads, just kind of walking around is what if this thing just comes out and hits my business from nowhere, and all of a sudden the show stops, the game ends, and we're done, right? And one of the powerful things is literally force yourself to scenario plan that out. Say, and we do this at Forecastr. What if our customer acquisition goes down by half? Right? What does that look like? And what you'll probably find, what most of the people that we walk through that exercise with finds, is that it's obviously not a better out. It's not a great outcome. It's not something that they can get excited about. But most of the time, your business will survive,
Right.
right? If you plan it appropriately. And so, how does this apply in the real world? Well, if things start to go south, and if your business is not working out the way that you want it to, you always have a plan B to fall back on, and you already know exactly what that looks like, and you've already done the math, and you've already done the planning to support it. And most of the time, it's not as bad as you think. And so when a lot of founders do that, they just breathe this sigh of relief of like, oh, I can kind of chill out a little bit, because even in my worst case, worst thing ever, I still have this cool business and I can still pay myself, and I can, yeah, maybe I have to let some people go, but like I can still do this. And so it's a decision making tool, but it's also a kind of stress reduction tool is kind of how I think about it.
Absolutely. I love that because I think, we all do love the rosy glasses and, this big picture. We're all going to be Facebook, and in reality, we're somewhere in between. But to your point, I think that, worst case scenario gives you that confidence of, I have a plan to survive, and that frees your mind up to ultimately go and try and achieve that beautiful end dream that you want. And that might mean that I have to let go of some employees, sell a truck, sell a route, whatever it might be, depending on your scenario. But I still have my business. I still live to fight another day. I'm going to be okay. I can be, knowing that I can be riskier in other bets as well. And so I think that's confidence at the end of the day. And without understanding those different scenarios, it's just stress. And so I think one of the beautiful things about this is you can shift that stress into confidence by really understanding your numbers. And especially if you work with a partner to do so, then you're not just guessing. And I think that's where so many people end up losing their businesses, because you're guessing, you're hoping, and you don't have a true plan. And all of a sudden, clocks up, and that's the 80%, right? And that's the biggest challenge. So thank you for highlighting that and really outlining it. And I know we're coming up on time. And so what I'd love to ask you kind of to wrap this up is, I hope there's folks that are like, yes, I need to take this next step and get really in the weeds. But if you were going to give somebody that's, just starting out, business is small but growing, what's a first step that they could take to begin this process and at least set themselves up for better success as they reach these goals where they can utilize a tool like Forecastr?
It's a very good question. First step, You don't have to do any forecasting. You don't even have to have an accountant to do this, but just set up a meeting once a month where you open up your bank account and you, for an hour, look at what happened to cash. That's step one, is getting that diligence of just once a month, we are going to set up a time where if it's just me, the business owner, or me and a small team, we look at cash and we try to see what was cash last month, what's cash this month, and then what happened. Right. And that's a great first step. If all you do is that, then you're already starting an FP&A process. You're starting a process of looking at finances, trying to understand what happened. So that's step one. And if that's the only step that you take, you're gonna reduce your chances of failure and increase your chances of success significantly just by doing that.
That's awesome. That's a great tip, a great place to start. Logan, thank you so much. This has been so great for myself and I'm sure our audience out there, because this is such a stressful piece of building a business. And so I hope the audience took a good amount away from this. We'll share more about Forecastr. And if it is interesting, please reach out, because we do believe that understanding your cash flow, your business, this is what keeps you alive, what keeps you building. So thank you so much for the time.
Thanks so much, Pat.
All right. Until next time.